So we do have a couple things to wrap up today. The week hasn't yet finished, as everyone know, but we do have a few of US retail sales still. So that's where I want to just, touch base a little bit. Then we're going to understand the CME Fed Watch tool, what is going on with that, because something just happened from yesterday to today. And I want to, if you guys saw my YouTube video today, you most likely know already what happened. But anyways, I would like to see if you guys can notice the change between from yesterday to today and what is the main changes, that were made in a sense. Then we will go for the DXY and where we will go from now. Because with the change on the CME, it can be quite persistent, okay? Because we had the CPI, the most awaited after the NFP release. We had the CPI 2 days ago, pretty much. It was on Tuesday night. So that was quite of a surprise for the market in a sense, just because we had the CPI coming in expectations and in line with expectations in a sense. And that was quite not what the market was expecting, because after a few minutes of the release, the CME Fed Watch 2 didn't quite move. And that's understandable because the market was quite of like, oh, okay, cool. They didn't had any changes. So in a sense, it continues to be the same. Okay. But now, from yesterday to today, when I came into the office, I went to look at the CME. I was like, what just happened that I don't know. So that's exactly what I want to show with everyone. Okay, cool. So hope everyone is having a great week. Let me see if there is anyone new here. Over the US retail sales first, okay. For that, I've already left the economic calendar open here for the Pinlogic's economic calendar. And we can see that tomorrow on Friday, we're going to be having the release of the retail sales. Right at the bottom here, we can see retail sales. Okay, and here as well. So the expectations are a smaller decline into the retail sales for the month July. Then we go the retail sales excluding auto. So the month as well, it is expected to be a decline from 0.5 previously to 0.3 now. And for the retail sales control group month, again, is expected to be a decline from 0.5 to now 0.4. These are the expectations. As I say, it's nothing like, it's not the release yet. We have to wait for the release, but it's going to be released at 10:30 p.m. in Australia time tomorrow. So most likely, if you guys remember, I did a video. Okay, let me just go and show that very quick for everyone. Shorts here. I did this video here on the US CPI, just got released on that day. Let me take up the audio. Perfect. And that was literally less than 4 minutes after the release. Okay, I was in my home, in my office at my home. I just got the phone, recorded the video, and put the risk disclaimer at the end, put the title, and send it to YouTube. That's it. So it took me less than 5 minutes to do this video. So, and I've asked everyone if everyone sort of liked that content, and everyone said yes. So I will be doing this again for tomorrow retail sales. Of course, it won't have the same effect into the market as the CPI. Okay, don't expect huge moves or anything like, enormous or something like that from like same as we had on the CPI to the retail sales. No. Otherwise, it would be much more important for us to be trading retail sales in a sense. But anyways, it's not the point. So just be mindful that I will be sending the release of the video into the Telegram as I did, so you guys can follow along and see if there is any opportunity to be traded there. Now, what I want to say here is that the retail sales has a huge influence on the inflation. And does anyone know why? Send me on the chat. Let me see if you guys understand quite of a, just sort of understanding a bit of the inflation measures and how the inflation gets generated in a sense. So what does retail sales has to do with the CPI, the Consumer Price Index? No answer so far. Okay, you guys still thinking? I'm gonna let you think. Maybe we're gonna get an answer now. No. Okay. So it's quite simple. Okay. I just want to give out the answer before anyone sends it. So most likely, I don't think anyone will know, but that's fine. It's completely fine. So the answer is quite simple. Think about how does the inflation get generated? So the CPI gets higher and higher and higher. So Zodwa just replied, and her answers say, because it's what the consumers are using on a daily basis. That's quite there. It's very, very close to actually be the right answer, but you are on the way to be correct. So just a minor tweak here is it's because the consumers are spending money on the daily basis. Okay. Maybe you wanted to mean that, but that's, it's, as I say, it's 90% correct. But the spending of money into the economy generates inflation. Okay, it's not about inflation gets generated out of nowhere. Okay, it's basically a cycle. Okay. Let me see if we get a photo. Maybe this one. Understand? Nah, yeah, they don't have it, but that's cool. They don't have the inflation cycle. But basically, imagine a circle, right? And there's basically three main points. The first one is the production. The second one is the consumption, and the third one is the inflation. So it's a circle that the product starts on the production, then that production gets sold, so the population consumes that, so basically spend money to buy this, and then that generates inflation, and the inflation goes to the consumer, goes to the production, and the production will be expensive now, and then they will pass on the inflation that they are paying to the end consumer. So that means if they were buying a piece of paper to make a book 5 years ago, each piece of paper were costing 1 cent and now it's costing 2 cents. That's 100% increase. Okay. Do you think they will charge? Do you think they will? Okay, let's still selling to the end consumer. So that's me and you for 1 cent each page. So let's say the book has 100 pages, right? So that would cost around $1. Well, not $1. Yeah, let's just work on that, on $1. Okay, so they were selling the book 5 years ago at $1. So now, do you think they were still selling the $1 because the production cost is $2 now? So they're basically not making money, they're losing money. Of course not. So what they would do is they would try to pass on the inflation to you. In a sense or another, they would try to do that. So the easiest way to do this is from a $1 final price, now we can charge $3 final price because $2 cover all costs and $1 is a profit. So we're charging $3. Then this $3 is not the one you're going to get. because it's probably a wholesale bookstore that is buying from a wholesale individual that is selling for $2. So now that book has to be done profit for the bookstore as well. So the production of that book sold for $3 to a bookstore. The bookstore bought it from $3. So they need to allow at least sell for $6. So one thing that costed $2 to be made has already made two people profit, basically. And you're buying much more expensive, like 100% more. So you're supposed to cost $3 5 years ago, and now it's costing us $6. So this makes you spend more money to the exactly same thing as you were 5 years ago. Okay. And that can be food, that can be electricity, that can be any other point, and it can like water, anything except for commodities, of course, because commodities are it's an scarce mineral. So we don't. Anyways, just forget about that. But you understand what I'm trying to say. It's basically you spending more money for the exactly same thing you bought with less money 5 years ago, and that is inflation. Okay, it's something that is inflated. So how does the central bank do to combat that? Well, they try to raise money, they try to do open market operations, they try to do the bonds, well, they try to do lots of things. They have a lot of measures they can control, but the most used ones are the OMOs, that is the open market operations into the currency market, or the rates. Okay, or quantitative tightening and quantitative easing as well. So these are the four most typical and easy to spot when a central bank is doing it. So with the rates higher, the bookstore will, like 5 years ago, the rates were lower, was only 2%. They were producing 100 books per day because it was cheap to borrow money from a bank, because the bank, the commercial bank, like, I don't know where you guys are from, but here in Australia, the Commonwealth Bank, or even the NAB, the National Australian Bank, St. George, Bank of Australia, Bank of Sydney, that kind of thing. Banks, they're called commercial banks, okay? And they get the rate from the central bank. So the central bank just lowered the tax. The rates here last 2 days ago on Tuesday, and the rates are now at 3.6 as it were 3.85 before. So that 25 basis point is basically 0.25% less that the commercial bank is it's being charged to get money from the central bank. So now they can actually pass that loan to business or to individuals with a lower rate, and therefore the rates on top of that can be 4% now, as it were 4.65% before when the rates were higher. So that stops the population, or it doesn't incentivize the population to make spendings into the economy, and therefore with that the population just steps back and sort of think a minute before they actually go to the bank and ask for a loan to buy a property. But a step before that is the production. Okay, so that's why retail sales is so important. Okay, the retail sales, it doesn't measure the inflation, but it shows us how the population is spending the money. Are they spending more than previously? Are they spending less than previously? Are they spending the same? And that will show me if the population is, in a sense, confident or not to spend money, or if they are in need to spend money at somewhere at some point for some reason. Okay, so that is the main idea of why retail sales is important and why you should pay attention into the retail sales release as well. Did I make it clear? Do you guys understand now? Do you have any questions? I know it's quite a big, I speak quite a lot, but I didn't want to jump any topic. Very clear. Okay. Thanks, Zodwa. That's great. Do you guys have any questions before we move to the next topic? We're going quite quick already. It's already 20 minutes. No? Okay. So moving on, the next topic is the understanding the CME Fed Watch tool. So for those who don't know, this is the Fed Watch. Okay. I'm going to send the link into the chat so you guys can open that. Perfect. Okay. Interesting. Anyways, now looking at this, some of you, I mean, most of you who are here are recurrent people. So that you guys come here pretty much every Tuesday to Thursday. So I really thank you for your time. But looking at this image, what do you see as different from yesterday or from actually Monday? What do you see as different? Let's see if you guys understand what I'm trying to point out, because it's really, really important. Okay. No, no one's probably going to notice. So I'm going to have to give a sort of like a hint in a sense. Look below, just over these numbers. Look at just over these numbers. Okay. Nothing yet. Okay, that's fine. No, we got a message, let's say. There's a 100% cut for September now. Yes, that's correct. It's literally 100%. It's not 95.8. It's literally 100%. Can someone tell me why now? I want to make you guys think. I don't want to give, at the same time, of course, I'm giving everything spoon fitted for everyone every single Tuesday, every single Wednesday, and every single Thursday. But I want you guys to be thinking as well to get the answer. And because I'm not trading with you 24 hours a day, you are on your own after 5 p.m. Sydney, and that's the only time we got. And but I want you guys to be able to think for yourself as well. Zoda is the only one that is answering my questions today. Okay. All right. I know it's a bit tricky one, but it's correct. The market has priced in 100% cut, 100% chance of a cut into September. And the reason here is because if you look, actually, let me get my squares. If you look at the current target, we're at 425 to 450. Okay. 425 to 450. If we look at this biggest one at the 95 pricing chance, and we look below that, we have 95% probability, 95.8% chance of cutting the interest rates to 4 to 425. Okay, so that is a 25 base points cut. Now, if we look to the smallest version of it, only registering 4.2% chance, we still have a cut. And that's the whole point. It's not about will they cut or won't they cut. They actually will cut. And it's probably going to be a 25 basis point. But did you guys got it? Because we don't have the hold over here. We don't have a hold. As on Monday, we had it a hold. Do you guys remember that? So on Monday, we had a possibility of 40% or 60% of, no, sorry, yeah, it was 40% of a possibility of holding the interest rates into the meeting of September. As of now, that possibility got excluded, and there's no possibility of holding, and there's only one possibility, doing a cut. So the market is 100% priced in for a cut. It doesn't matter how much it's going to be. We already know it's going to be a cut. Okay, so that's what I'm trying to show for everyone into the webinar today. And this is where the gold is. We know this. We need to take advantage now from that. What can we do? Well, that's exactly the next topic I want to talk with you guys. It's about the DXY. Where will the DXY go? But before we go further, I want to show something else for everyone. I want to show actually two more things. Let's go just on the 2 years and the 10 years bonds. Let me overlay the 10 years here. Change that to line. Perfect. So on yellow, we got the 2 years, and on pink, we got the 10 years. And that's the 10 years and the 2 years US Treasury bonds. Okay. Remember I say on Monday we had a possibility of maintaining the rates as no change. Monday was, let me just grab that one first. Monday was right here. From that dot line from that dashed line to this dashed line. Okay, so that was Monday. Tuesday, when we had the release of the CPI, were at 10:30. Okay, so let's put 11 because I don't have 10:30. That's a 1 hour chart. And then until 24 hours on Wednesday, that was here. So from here to here, it's when we got the release of the CPI saying that the inflation is pretty much in line and a bit below of what was expected. Coming from an NFP that was right here, so the NFP was right here at this to this. So this was the release of the NFP, okay? So to better understanding of everyone, what we can do is we can just NFP. I highly recommend you guys to do that. Oops, sorry, wrong one. Monday. And then we do something like that. And then, oh, well, I can do a better one. Just a second. Let's do an hour. Monday. And then here we do CPI release. Okay. So we had the NFP release that was much lower than expected, 50% lower than what was expected to be. That was a really, really bad NFP. The market repriced itself already to a possible cut into September, but still doubt about would that be cut it or would that be a hold? Because we can see here on the yields already. Let me grab a brush. From here, we can see that there was some sort of up move into the yields that were predicting maybe no cut, and we're going to be maintained the same until the CPI release, until the inflation release on Tuesday. Okay, so that's the whole idea. That's the whole point of what I'm trying to show everyone today. The Fed is going to cut, period. And we need to take advantage of that because we already can see this. The yields are screaming that. The CME Fed Watchers is screaming that. And what will happen? It's not about the cut. The cut, as I say, most likely everyone can just come here and look at this and they will know and they will understand. Okay. You can look at the economy scenario and you can see that and you can understand that this will happen. Now, what will be even bigger will be the Fed on September. Jerome Powell actually giving a speech saying that they are looking at the labor market that has been, been easing with with inflation been easing as well. This is going to change the whole perception of the whole market, and this is going to be catastrophe for the US dollar. So US dollar would definitely go below the 98 that is already trading below 98, but it will go to 97. US 500, well, CPI, S&P 500, Nasdaq, all of those higher interesting rate, higher interest and higher risky will be taking advantage and will be eating all new time highs, just like Bitcoin, $123,500, all new time highs again. Gold will suck. Gold will be continue trending on the range. Okay, so hear me out. I'm telling you, Euro dollar 120, Aussie dollar against the US dollar 68 cents. Before it's too late, guys. I'm really telling you that. Okay. So coming back to here, that's the first thing I want to show you. Now, going to the second thing is the first thing I want to show you is the bonds that's screaming that, all right, in combination with the September 2025 rate cut. Now, if we go to October, we have 65% already priced in for a cut. Watch out for when we got the release of the retail sales, this 32 gets diminished. Okay, so we're going to have a 25 in September, a 25 in October, and a 25 most likely into the month of December. So we are heading to 75 basis point in 3 months. I can't swear here, but I really want to say some F words. Okay, so we will go to 75 basis point in less than 3 months. This will be bearish for the US dollar. Okay, currencies like Australian dollar, New Zealand dollar will be favorable. Euro and the pound will be favorable. Gold, who wants gold? Not anymore. Bitcoin, S&P 500 and Nasdaq will be favorable as well. Listen what I'm telling you to then don't come and ask the same question. Listen what I'm telling you. S&P 500 up, Nasdaq up, Aussie dollar up, New Zealand dollar up, Euro up, pound up, Bitcoin up, gold down, US dollar down. I just gave you 10 trade simple ideas. Now it's up to you on your own imagination to go and grab your thinking and apply this into your daily trade. Did I make it clear? Because I don't think I can give it more clear than that. Okay. Now, where will the DXY go from now? Let's come back to the trading view and go into DXY. Let me take this thing off. Candles. Guys, a few people have been asking me what just happened here on this huge candle. I really don't know. I think it was a bug, some sort of bug from this pricing, because if I click in another one, it doesn't happen. Okay. So I'm not too sure what happened over there, because even if we look on like euro dollar, for instance, we don't have any huge things as well. Okay, so it's I don't know what is this green sort of candle here. I think it's just a random bug that happened. But anyways, So this is the CPI release. So we have the CPI release. Perfect. So the market was down 0.73% after the CPI release. As I say, once the CPI release happened, we didn't quite had any huge moves. CPI release was actually here. We didn't had quite of a big move when the CPI came out. This is a 1 hour chart. Because if we look after on the next day, on Wednesday, on yesterday was actually the big move, like 4 p.m., was where the moves were kind of happening. And then now today's sort of stagnated until we got the release of the retail sales tomorrow night. So most likely, as I say, we broke below the 98. So 98 over there. So we just break below that 98. Market doesn't seem like it's quite sustainable where it is at the moment. So most likely we may see a pushback on 98 again. So that will give opportunity for those who are not into trades like the pound against the US dollar, the euro against the US dollar, the dollar against the yen, etc., to get in and to get into those trades and be able to hold them and carry them since next month September, like in a month or so, we're gonna be having in a month, well, a month and 3 days, we're gonna be having the Fed FOMC Fed rate decisions that are is expected a cut already. So this is the most key scenario in my opinion. Zod will say, yeah, I'm also waiting for that pullback from the dollar. Yeah, so most likely wait approach is the best approach at the moment. Don't, I'm hyping everyone here in a sense, but it's not about I'm saying this today and it's going to happen like it's going to be huge. It takes time. It takes time. Okay, so don't go too hot into the pot. Go slow. Okay, go like if you want to start building positions, it's definitely good breaking down positions in quite of a big way, like a big position, like a full lot sizes, you can sort of break down because the first potential target for Eurodollar, it's already here, it's already targeted. So 120 would be my main target for the whole year end of I would say 2025. Okay, so the first potential target is nearly there, and 120 would be my main point of finishing the year over at that target. So waiting for the pullback of the US dollar index would probably give us a better opportunity to enter into the market for like euro dollar longs. So in a sense, like we can probably see something around here and then a continuation up until 120. Okay, so something around those lines, even more, even somewhere around here. The lower the pullback, the better. Okay, the lower the pullback, the better. So it is definitely a good opportunity to be looking to long euro dollar. It just depends. It doesn't go long now. It's not about that. It's about waiting a bit on those scenarios. Okay. Now, US dollar Japanese yen is as I say, it's a very sensitive currency, and we got this trade wrong, but that's fine. So what I'm looking here is pretty much, as I say, the Japanese yen is a very sensitive currency, and whenever the dollar is strong, the Japanese yen is very weak. Whenever the dollar is weak, the Japanese is strong. The Japanese yen is very strong. So it's just that sort of interplay that we need to take care of. I reckon with that trading, I think that the market didn't quite see that opportunity just yet because, in my opinion, Japanese yen is undervalued, okay, and the US dollar is sort of overvalued at the moment. I think that the most suitable scenario for US dollar Japanese yen would be 142 targeting first and then 140 targeted second by end of the year. So there's plenty trades to be done here. It's just going to depend on how patient you are. So yes, I'm bearish on the US dollar Japanese yen. So I'm looking to short that market, okay? The next one would be the pound against the US dollar, just over here. So the pound against the US dollar moved without us, but as I say, we were on the right direction. Um, Most likely, if the DXY have a pullback, we will probably be able to catch this pullback into the pound in the sense of the pound going down and the US dollar going up. We can catch a pullback to go long into the pound against the US dollar, and from there, most likely, then we go. We could be going long. Okay. Cool. Is there anything else I should talk to? So your dollar. Well, then of course the New Zealand dollar and the US dollar and the Aussie dollar. So this is an opportunity right here. Got triggered the order. So watch out because most likely we're gonna be stopped down. Most likely the market will come even lower, and it's an even better opportunity to be looking to go long on the New Zealand. The other one is, as I've been mentioning that for ages now, is the Aussie against the US. Okay, so be very attentive in a sense for the Australian dollar because I guess there's a lot of potential hidden into here. So even that we are starting to cut the rates, it doesn't matter much, okay? Because the forward guidance is still quite bearish and very data dependent. As I say in the beginning, the FOMC will change the data dependent approach and will be more like the dovish, leaning to dovish, and that's why I think the whole trade will play out. Okay. Um, cool. So let me just go over through everything again. So the US retail sales is going to be dropping out tomorrow, and it's going to be really, really important for us to see if there is like a confirmation from the CPI going down and then the retail sales slowing. So people are spending less money into the economy. So that's great. So showing that the inflation, or there is a potential for inflation to continue to go slow but down. The CME Fed Watch 2, there's no possibilities of now no cuts. It's only showing for the next 3 months higher probabilities of cut. So 75 base point is predicted to be on the next 3 months. And my opinion about the DXY is that the DXY most likely can continue to go down and reach the 97 level. Okay, cool. So that's pretty much it from me today and for this week. And I hope I could help you guys to understand a little bit better how the things are going and answer some questions as well. It's always good to have this chat with everyone. So enjoy your weekends, and tomorrow, as I say, at 10:30 p.m. Australia time, when the US retail sales will be out, I will be doing a video, and most likely at 10:40 max, you're going to be able to have that video. So 10 minutes after the release, you're going to be looking to get that video on your hands. Okay. Not a problem, everyone. Thanks, Wits. Have a great weekend, and I'll chat to you into the next week. Oh, someone actually sent a question. What are your thoughts on Forex prop firms? Look, that's a really good question. It's it's a good question. It depends. It's my personal, okay? Nothing to do with ACY, nothing to do with the market. It's just my personal opinion. Now it's Luca talking with everyone. It's not Luca from ACY. Uh, it's it's good. I've been into a few prop firms. Okay, I've been. Most likely you guys know FTMO. I've got a few payouts with them in 2022. So 2021, 2022 was quite good. The money arrived pretty quick. So I've had a not the but things changed quite a lot, from there to now because I was looking to get another prop firm this year, called a Q2 Tenkel, and they had something called consistency rate. So I was making like $5,000 in the first 2 weeks, and my consistency rate was above 35% or above 30% because I've made only a few trades, and those trades were big trades. So basically, the system was understanding that it was luck, but it wasn't luck. I definitely knew what I was doing. So therefore, my consistency rate was like 80%. So basically not consistent. And I had to be below 30 to be approved. So I was like, that's no sense because they are capping how much money I can make. And then I've did my calculation was like I couldn't make more than $200 in profit per day. So I was like, no, thank you. No sense to do that. So I ended up just giving up on that one. I was on the first phase of on the test, but because they had a very good deal, it was like $100 for 50K account. So now my thoughts are: if you don't have money sufficient, if you don't have a 50K, 100K account personal, then yes, go to prop firms, but make sure your risk management is top tier because make sure you understand the rules. It's a really dodgy industry in my opinion. And as I say, I'm speaking as myself because I did quite a bit of research. There's a lot of things on Google that you can search about. It's a very dodgy industry. It's different from a broker. Okay, there's nothing to do with broker. They're basically there. If you lose money, they make money from your registration fee. So just keep that in mind. That if you are making too much money, they will probably be capping you in a sense and not paying you out, okay? Because you're trading a demo account. So basically your payouts are getting from other people that are losing they tests, and that money don't get back to them. It stays with the company. So the company pay you with that money. It's not pay you with the market money, okay? So just keep that in mind. But it's good. It's good. Like FTMO, it's a serious company. Like go for serious ones that are great and have a good name, a good and big name into the market. All right, that's enough. Thank you so much, everyone. Hope I helped, and have a great weekend. And I speak to you next Tuesday. Cheers, guys. Bye bye.